𝗗𝗟𝗧 just made a bold call that could completely change how you see this market right now. He says up to 90% of the market drop is already behind us, and according to him, the risk-reward for stocks is starting to look very attractive again. In this video, I'm going to show you the exact clip from his CNBC interview. Then I'll walk you through my own reaction and what I think he's getting right and what investors might be missing. After that, I'll take you deeper into 2 hypergrowth AI stocks that could benefit the most if this setup plays out the way he expects. Let's hear what 𝗗𝗟𝗧 has to say.
Good to see you, Tom. March came in like a bear, stayed like a bear for, I think it came in about 6,900 on the S&P. We got 6,350 or so, and then a bounce. Last week we're back to 6,580. Your call, I think, like so many of your calls, there's some volatility near term, but then a successful resolution by the end of it. That didn't quite happen in March. I think maybe things are taking longer than you thought for the war, but you're kind of just pushing it back a month, are you not?
Yeah. You know, as March unfolded, the war looked like not to be a short war, but, you know, one that was longer, and I think markets have been adjusting to that. But as you know, we're still in the midst of this fog of war because we don't know when it ends. But we did look at the past 7 major war events, and the stock market adjusts pretty quickly. Within the first 10% of the entire duration of a war, the stock market usually bottoms. So, you know, World War II was almost 5 years, and the market bottomed 5 months into that war. So I do think, as bad as March was, we've probably seen a big part of that adjustment. And now I think the risk reward is quite good for stocks.
And 90 to 95% of the weakness is behind us, in your view.
Yes. And I think people are kind of torn because if someone sold in March and the market, they may have sold 3 or 4% off the highs, and we're just 5% off the highs, they've got a dilemma because the market's only a little bit lower than where they might have sold, but it wouldn't take a lot for the markets to begin to recover. So I do think investors who've gone to cash really have to start to think about how war, as much as it's a crisis, people focus on the negatives initially, but then they need to start thinking about the opportunity on the other side.
We talked about the false start in oil when it sold off. There was also a day where we were down 200 or 300 points. Trump said something and we were up 1,300 points. So is it spring-loaded right now, but wary? It's like, I think everybody said, well, yeah, we've seen this before. We're going to need more real evidence before it makes a move again like that. But what kind of move would it make if there was a definitive agreement that Iran even admitted to? Because they haven't admitted to anything yet, but that's their playbook.
Yeah, I mean...
You think spring-loaded?
Really spring-loaded because, one, we know that policy and the path of the war is more important than the central bank. So that's the single biggest driver of the stock market. The stock market's getting a bit of a boost from all the defense spending. So the economy is not in horrible shape.
Oil stocks are doing pretty well, too.
Yeah, oil stocks are doing well. But then if there's Middle East peace, of course, that's got a lot of future benefits. So I think if there is a surprise and the war does end, you know, the reaction would be very explosive, as you said.
I just want to read you what, and we're talking about, Leslie was talking about earlier. This is the Jamie Dimon letter. Mostly bullish, but then makes this point at the end, sort of one section, where he says the skunk at the party, and it could happen in 2026, which is now, would be inflation slowly going up as opposed to slowly going down. This alone could cause interest rates to rise, asset prices to drop. This would make Kevin Warsh's life a lot more difficult. And interest rates are like gravity to almost all asset prices. And falling asset prices at one point can change sentiment rapidly and cause a flight to cash. Your reaction to that?
Well,
and that's, by the way, his downside scenario. I mean, that's sort of how he's laying it out.
I think that's everyone's concern because we've had several inflation shocks now in the last 6 years, right? The first was the COVID supply chain, and then was the tariff shock, and then this is a war shock that's going through, and nobody wants consumers to suddenly expect higher prices. So I think that's what everybody is watching carefully. But it doesn't mean that just because prices are going up because of this, of gasoline, that inflation expectations are unanchored. So I do think right now it's a critical time for the Fed to have credibility and for consumers not to expect higher prices going forward.
So 7,700 is still your call by the end of the year. Becky and I, we did some great work on Friday. I don't know whether you saw, but
Full hour's worth.
We did an hour, but we brought a really good jobs number to the that was a surprise to everyone. The risk on both sides of the dual mandate has been in the forefront of everyone's mind. You can't even, they're both so bad, you can't even figure out which one is worse. Did that alleviate the weak labor market fears, the recession fears that have been creeping into the market because of the war?
Yes. And I think investors need to keep in mind that wartime spending is, $30 billion and maybe going up to $100 billion a month of economic stimulus, and that does boost the economy. Gasoline, every $10 is about $4 billion to $5 billion a month hit to the consumer. So the monthly spend from the war is much higher than the effect from oil.
Yeah, that is a cynical viewpoint about war.
Yeah.
Forever about war, about how.
Is that why you are not as worried about inflation sticking in there for the longer term?
It's if this is a shorter war and the oil curve doesn't seem to expect it to be into year end, then it's an inflation shock, not a inflation
But
episode.
You don't think the Fed's going to be cutting rates anytime soon if it's not worried about the jobs picture?
No, it wouldn't make sense in the near term. I think market expectations are correct there.
Crypto's fine? You're not, yeah?
Well, after energy stocks, which have done well since the war started, the second best performing asset is Ethereum, and the third best is Bitcoin. They've both been up on an absolute basis and beating the equity market.
The first thing that stands out right away is the context. The market just went through a rough stretch. March came in heavy, very bearish sentiment, and we saw a pretty sharp drop from the highs before bouncing back. And the interviewer is basically calling Tom Lee out, saying, look, your call was that there would be short-term volatility followed by a recovery, but that recovery didn't come as quickly as expected. And this is where Tom Lee reframes the entire narrative. He points directly to the war, and this is key. He's essentially saying the timeline shifted, not the thesis. In other words, the market didn't invalidate the bullish case, it just delayed it, because the situation turned out to be more prolonged than initially expected. And personally, I think this is something a lot of investors miss. They treat timing errors as thesis failures. But those are two completely different things. You can be early and still be right. Now here's where things get really interesting. Tom Lee brings in historical data. He talks about how markets behave during wars, and this is not speculation, this is based on past major conflicts. He says that historically, the stock market tends to bottom within the first 10% of the duration of a war. That's a powerful statement, because what he's implying is that markets don't wait for clarity. They don't wait for the war to end. They price in the uncertainty early, and then they start moving forward while the situation is still unresolved. He even gives the example of World War II, a nearly 5-year war, but the market bottomed just 5 months in. So when he says that 90 to 95% of the weakness is already behind us, he's not just guessing, he's anchoring that view in historical behavior. Now, do I fully agree with that? I think the logic is solid, but the market today is more complex than it was back then. You've got faster information flow, algorithmic trading, global interconnected risk. So while the pattern may hold, the speed and magnitude could be different, but the core idea still stands. Markets move ahead of reality, not with it. Then he shifts to investor psychology, and this is where I think the real message of the interview is. He talks about investors who sold during the drop. Maybe they sold 3 or 4% off the highs, thinking they were protecting themselves. But now the market is only slightly below where they exited. So now they're stuck. Do they buy back in and risk looking wrong, or do they stay in cash and risk missing the recovery? And this right here is one of the biggest traps in investing. It's not just about being right or wrong. It's about how you react after you make a decision. Because once you go to cash, you now have to make 2 correct decisions. When to sell and when to get back in. And most people get the second one wrong. Tom Lee is basically saying that this is the moment where investors need to shift from fear to opportunity. That initial panic phase is over, and now the market is transitioning into a different phase. Then the conversation moves into something really important, the idea that the market is spring-loaded, and what they mean by that is this. The market is extremely sensitive right now. It's reacting sharply to headlines, whether it's geopolitical comments or policy signals. You saw that example where the market flipped from down hundreds of points to up over 1,000 points in a single day. That kind of volatility tells you something. It tells you that positioning is fragile, sentiment is uncertain, and capital is waiting for a trigger. And Tom Lee leans into that. He says, yes, the market is spring-loaded. And more importantly, the biggest driver right now is not the central bank. It's policy and the direction of the war. That's a big shift. For a long time, everything revolved around interest rates and the Fed. But now, geopolitical outcomes are taking center stage. And here's where the upside scenario becomes very clear. If there is any kind of surprise resolution to the conflict, the market reaction could be explosive. And I agree with that, because markets hate uncertainty more than bad news. Once uncertainty is removed, even if the outcome isn't perfect, capital starts flowing again. Now they bring up something that adds tension to the whole bullish case, and that's inflation. They reference Jamie Dimon's warning that inflation could start creeping back up, which would push interest rates higher and put pressure on asset prices. And this is a real risk. Higher rates act like gravity on valuations. The higher the rates, the harder it is for stocks to justify high multiples. Tom Lee acknowledges this, but he reframes it again. He breaks inflation into shocks versus sustained trends. He points out that we've had multiple inflation shocks over the past few years. Supply chain disruptions, tariffs, and now war-related price increases. But a shock is not the same as a long-term inflation cycle. And this distinction matters, because if this is just a temporary spike driven by energy prices, then the long-term inflation outlook may still be stable. And this is where he emphasizes the role of the Federal Reserve. He says it's critical that the Fed maintains credibility and that consumers do not start expecting higher prices going forward. Because once expectations shift, inflation becomes much harder to control. Now personally, I think this is one of the most important parts of the interview. Inflation is not just about numbers, it's about psychology. Once people believe prices will keep rising, that belief alone can drive behavior that makes it happen. Then we get into the economic side of things. There were concerns about the labor market weakening, recession fears creeping in, especially with everything happening globally. But then we get a strong jobs report, and Tom Lee uses that to reinforce his view. He brings up something that might sound controversial, but it's rooted in economic reality. He says wartime spending acts as a form of stimulus. He's talking about tens of billions of dollars flowing into the economy every month. That kind of spending supports growth, offsets some of the negative impacts, and keeps economic activity going. Now I get why that sounds cynical. Nobody wants to frame war as economically beneficial. But from a purely financial perspective, government spending on that scale does have a stimulative effect. And when you compare that to the drag from higher oil prices, the net impact might not be as negative as people assume. So when you put all of this together, Tom Lee is painting a very specific picture. Short-term volatility driven by uncertainty, but underneath that, a market that has already priced in most of the bad news. A market that is sensitive, reactive, and ready to move, and a macro environment where the economy is holding up better than expected. Now, does that mean there are no risks? Of course not. Inflation is still a wild card, geopolitical developments are unpredictable, and timing is always tricky, but if you strip away the noise, the core message is this. The sell-off may feel scary, but it may also be where the opportunity is being created. And this is where I want to bring it back to you as the investor watching this. Because moments like this are uncomfortable. They test your conviction. They make you question whether you should step aside or lean in. But historically, the best opportunities don't come when everything feels safe. They come when things feel uncertain, but the underlying fundamentals are still intact. And that's exactly the setup Tom Lee is pointing to. Now, let's dive in and talk about the 2 hypergrowth AI stocks to buy in this current sell-off. Let's start with the first one, Palantir Technologies, ticker symbol PLTR. Before we even talk numbers, you need to understand what Palantir actually is, because this is where most investors get it wrong. Palantir is not just a software company. It is a decision-making platform built for a world driven by data and increasingly by artificial intelligence. Governments use it, military organizations use it, large enterprises use it, and the reason they use it is simple. It helps them make better decisions faster, using massive amounts of data that would otherwise be impossible to organize and act on. And in an AI-driven world, that capability becomes more valuable, not less. Now here is where the story gets more interesting. Palantir has positioned itself right at the center of the enterprise AI revolution with its artificial intelligence platform, often referred to as AIP. This platform allows companies to integrate AI directly into their operations in a way that is practical, scalable, and actually useful. And that last part matters, because a lot of companies are talking about AI. Very few are actually helping businesses deploy it in a way that drives real outcomes. Palantir is one of the few that is doing it at scale. This is why demand has been accelerating. The company has been seeing a surge in interest from commercial customers who want to adopt AI but do not have the infrastructure or expertise to do it on their own. Palantir steps in and becomes that bridge, and once they are in, they tend to stay. That is one of Palantir's biggest strengths. Its software becomes deeply embedded into the operations of its clients. It is not something you just switch off and replace. That creates a very strong moat. Now let's talk about growth, because this is where things really stand out. Palantir has been delivering strong revenue growth, particularly in its commercial segment. In recent quarters, U.S. commercial revenue has been growing at a much faster pace than its government business, which historically was the core of the company. That shift matters. It shows that Palantir is not just reliant on government contracts anymore. It is expanding into the private sector, where the total addressable market is significantly larger. And this is happening at the same time that AI adoption is just getting started. So you have a company that already has deep relationships, proven technology, and now a growing pipeline of commercial customers who want exactly what Palantir is offering. Now let's connect this to the current market environment. We are in a sell-off. Sentiment is shaky, investors are cautious, and this is usually when high-growth companies get hit the hardest. But here is the key: not all growth is the same. There is speculative growth, which depends on future promises, and then there is real growth backed by actual demand, real contracts, and expanding use cases. Palantir falls into that second category. The company has already reached profitability, which removes one of the biggest risks that investors use to worry about. It is generating cash. It is scaling its business, and it is doing it in a space that is becoming more critical by the day. Now I want to touch on something that I think is often overlooked. Palantir is not just benefiting from AI, it is shaping how AI is used inside organizations, and that gives it a unique position. Because as more companies realize that AI is not just about models but about integrating those models into real workflows, they will need platforms like Palantir to make that happen. This is not a short-term trend. This is a long-term shift in how businesses operate, and Palantir is building the infrastructure for that shift. Now let's talk about valuation briefly, because this is where some investors hesitate. Yes, Palantir has had a strong run in the past. Yes, it can look expensive on traditional metrics, but when you are dealing with a company that is growing rapidly, expanding its market, and positioning itself as a critical layer in a new technological paradigm, you have to think differently. You are not just buying current earnings, you are buying future dominance, and that is where the opportunity lies during a sell-off. Because when the market pulls back, it gives you a chance to accumulate companies like this at better prices. Now I am not saying this is risk-free. Execution matters, competition will increase, expectations are high, but if Palantir continues to execute the way it has been, it has the potential to become one of the defining companies of the AI era. And that is exactly the kind of business you want to pay attention to when the market gives you an opportunity. If this resonates with you, you're exactly who this channel is for. Please hit the like button, share the video, and leave your thoughts in the comments. Subscribe to the channel so you don't miss out on the next important financial investing update. Remember to do your own research before you invest in any stock. Now let's move on to the second company, because this one operates at an entirely different layer of the AI ecosystem, but it is just as important, if not more. Taiwan Semiconductor Manufacturing, ticker symbol TSM. If Palantir is helping organizations use AI, then Taiwan Semiconductor is the reason AI exists at scale in the first place. Because none of this works without chips. Every AI model, every data center, every inference engine, every training workload, it all runs on advanced semiconductors. And Taiwan Semiconductor is the company manufacturing the most advanced chips in the world. This is not just another chip company, this is the backbone of the global AI economy. And what makes this business so powerful is not just what it does, but how difficult it is to replicate. The level of precision, capital investment, and technical expertise required to manufacture cutting-edge chips is almost impossible to match. We are talking about years of research, tens of billions of dollars in capital expenditures, and an ecosystem that has been built over decades. That creates an incredibly strong moat. And in a world where demand for AI computing power is exploding, that moat becomes even more valuable. Now let's talk about why this matters right now. AI is not slowing down. If anything, it is accelerating. Companies are racing to build more powerful models. Governments are investing in AI infrastructure. Enterprises are adopting AI tools across their operations. All of that requires more chips. And not just any chips, advanced chips. Taiwan Semiconductor is at the center of that demand. The company has been seeing strong growth driven by high-performance computing, which includes AI workloads. This segment has become a major driver of revenue, and it is expected to continue growing as AI adoption expands. Now here is something important to understand. When you invest in Taiwan Semiconductor, you are not betting on one application or one product. You are betting on the entire ecosystem. As long as AI continues to grow, as long as data centers continue to expand, as long as companies continue to invest in computing power, Taiwan Semiconductor benefits. That is a very powerful position to be in. Now let's connect this to the current market sell-off. Semiconductor stocks can be volatile. They tend to move with sentiment, cycles, and macro conditions. So when the market pulls back, companies like Taiwan Semiconductor often get dragged down with it, even if the long-term demand remains intact. And this is where opportunity can emerge, because if the underlying trend is still strong and the company continues to execute, then short-term weakness can create attractive entry points. Now I want to touch on something that I think is critical. Taiwan Semiconductor is not just keeping up with demand, it is leading in technology. The company is consistently pushing the boundaries of what is possible in chip manufacturing, moving to smaller and more advanced process nodes that deliver better performance and efficiency. And this leadership is not easy to challenge. Competitors are trying, but the gap remains significant. That means Taiwan Semiconductor is likely to remain a key player, if not the dominant player, in advanced chip manufacturing for the foreseeable future. Now let's talk about financial strength. This is a company that generates significant revenue and maintains strong margins, even while investing heavily in future growth. It has the scale to fund its expansion, the demand to justify it, and the positioning to benefit from long-term trends. And in a market environment where investors are becoming more selective, that combination matters, because capital is flowing toward companies that have both growth and durability. Taiwan Semiconductor checks both boxes. Now I want to share my personal take here. One of the biggest mistakes investors make is focusing too much on the surface-level story. They hear about AI, they think about applications, they think about software, they think about the end products, but they overlook the infrastructure. And in many cases, the infrastructure is where the real money is made, because it is the foundation that everything else depends on. Taiwan Semiconductor is that foundation, and that is why it deserves serious attention, especially during periods of market weakness. Now, does this mean there are no risks? Of course not. There are geopolitical risks. There are supply chain considerations. There are macro factors that can impact demand in the short term. But when you zoom out and look at the bigger picture, the long-term trajectory remains very compelling. AI is still in its early stages. Demand for computing power is still growing. And Taiwan Semiconductor is right at the center of it all. That is a powerful combination. This video is brought to you by Value Stocks Investing Master Course. If you're looking to grow your wealth by investing in solid, undervalued stocks, but not sure where to start, I created the Value Stocks Investing Master Course to teach you how to identify great companies, make smart investment decisions, and build a portfolio that lasts. Click the link in the description and pinned comments to get the course today and take control of your financial future. Now that we've broken down both companies, let's step back and look at what this all means for you as an investor in this current market environment. When you look at both of these companies together, something very clear starts to emerge. You are not just looking at two random AI stocks. You are looking at two completely different layers of the same massive trend. On one side, you have Palantir, which is helping organizations actually use artificial intelligence to make decisions, optimize operations, and unlock value from data. On the other side, you have Taiwan Semiconductor Manufacturing, which is producing the advanced chips that make all of that possible in the first place. One operates at the software and decision layer, the other operates at the physical infrastructure layer. And when you combine those two, you start to see the full picture of where AI is heading. This is not a narrow opportunity. This is a broad, multi-layered transformation of how the world works. and both of these companies are positioned right at the center of that transformation. Now let's bring it back to the current market environment, because this is where things get really interesting. We are in a sell-off. Sentiment is uncertain, investors are cautious, and this is exactly the kind of environment where long-term opportunities often begin to form. Because when fear enters the market, prices can disconnect from fundamentals. Strong companies can get pulled down along with everything else, and that creates a window. But here is the key. Not every dip is an opportunity. Some companies deserve to fall. Some companies will not recover. The real skill is being able to identify which businesses have the durability, the growth drivers, and the strategic positioning to come out stronger on the other side. And that is where Palantir and Taiwan Semiconductor stand out. Let's break that down a bit further. Palantir is building a platform that becomes more valuable as data increases and as AI adoption expands. The more companies rely on AI to make decisions, the more they need a system to organize, interpret, and act on that data. That creates a compounding effect. As adoption grows, the value of the platform increases, which attracts more customers, which drives more data, which further strengthens the platform. That is how powerful software ecosystems are built, and once they reach a certain scale, they become very difficult to disrupt. Now compare that to Taiwan Semiconductor. This is a company that benefits from the growth of the entire industry. As AI demand increases, as data centers expand, as new applications emerge, the need for advanced chips continues to grow. And because Taiwan Semiconductor is already the leader in advanced manufacturing, it captures a significant portion of that demand. This is not a winner-takes-all situation, but it is very close. Because the barrier to entry is so high, only a few companies can even compete at this level, and Taiwan Semiconductor is ahead. So what you have here is a combination of two very powerful forces. A company that enables AI at the application level, and a company that enables AI at the infrastructure level, and both are benefiting from the same long-term trend. Now let's talk about timing, because this is where a lot of investors struggle. It is easy to get excited about a company when the stock is going up. It is much harder to feel confident when the market is pulling back, but that is often when the best opportunities appear, because the market tends to overreact in both directions. It gets overly optimistic during rallies, and overly pessimistic during sell-offs. And if you can stay focused on the underlying business rather than the short-term price movement, you can start to see those opportunities more clearly. Now I want to be very clear about something. This is not about chasing hype. This is not about trying to time the exact bottom. This is about identifying high-quality businesses with strong long-term potential and taking advantage of periods when the market gives you a better price. And that requires patience, it requires discipline, and it requires conviction, because the market will test you. There will be volatility, there will be headlines, there will be moments where it feels like things could go either way. But if the underlying thesis remains intact, those moments can actually work in your favor. Now let me bring this back to something we touched on earlier, the idea that not all growth is the same. Palantir is not just growing because it is a trendy AI name, it is growing because businesses are actively adopting its platform to solve real problems. Taiwan Semiconductor is not just growing because semiconductors are in demand. It is growing because it is producing the most advanced chips that are essential for the next generation of computing. That distinction matters, because it separates durable growth from temporary momentum. And in a market like this, that distinction becomes even more important. Now here is the question I want you to think about. When you look at these two companies, which one do you believe has the stronger long-term advantage? Is it the company that owns the software layer and becomes deeply embedded in how organizations operate? Or is it the company that controls the infrastructure and powers the entire ecosystem? There is no single right answer. Both have strong cases. But thinking through that question will help you better understand where you want to position yourself in the AI landscape. If you want exclusive stock tips, in-depth analysis, real-time trade alerts, and free investing guides, join the StocksGalore Patreon today and take your investing game to the next level. Our members get full in-depth analysis on most of the stocks mentioned here. Head over to patreon.com/StocksGalore and become part of our growing community of smart investors. Link is in the description. Do not forget to like the video, share your thoughts in the comments, and subscribe so you do not miss the next important investing update. Thanks for watching, and I will see you in the next one.